Video on the construction of financial statements for a sole proprietorship. So when you attack these questions, the first statement you want to start with always is the income statement. Notice the income statement is for a time period. In this question, it is for the month ended July 31st. So we are going to determine how profitable this company has been for that month of July using revenues and expenses. So within the statement, we're going to grab all the revenues that have been earned during that month and all of the expenses that have been used during the month. This company earns revenue in two different ways. The first way is tutoring revenue. So they provided $4,200 worth of tutoring revenue to their customers during the month. So just a reminder that revenues are the values of goods and services provided to your customers during the month. Since this company has more than one revenue, we need to total them up. Notice when we do our financial statements that we always do our calculations in a straight line. So I'm taking these two numbers. The underline denotes that the numbers above will be calculated, and I'll bring my total over to the right. Now we'll start grabbing our expenses, or the value of things used up while creating these revenues during the month. Notice that each time I take something from a question, I cross it out. This is very important because these numbers within the question will only be used once. The income statement tells the story of profitability for the company, but unfortunately, I see a big problem here. The cost of the things they've used up during the month is more than what they've been able to charge their customers, or more than the services they've been able to charge their customers for this month. Hence, instead of having profit or net income, they have a net loss. All right, next we have the statement of changes in equity. Equity talks about the ownership stake in the company. This statement is also for a time period, so it's for the month ended July 31st. So this statement will tell the story of the owner's stake in the company throughout the month of July and how that changed. This company happens to be a sole proprietorship. Milton Windsor is the owner. Now, if we look at the question gives us the capital for Milton Windsor July 30th. Capital is the account that captures equity within a sole proprietorship. So he ended the month of June with $7,400 in equity, and that is the exact same amount he started off the day July 1st, or the first day of the month, the first day of July. The next thing that adds to equity is investing. So Milton invested $1,200 into the company during the month. So I need to get that. Increasing his equity throughout the month. Now, at this point, if there was net income or profit generated by the company would have been working on Milton's behalf, and that would also increase his capital in the company, or increase the equity of the owner in the company. Unfortunately, the company had a loss during the month, so that net loss will actually detract from his equity during the month. So we'll less net loss, And also, withdrawals decrease equity. And look at this, Milton, he withdrew $1,000 from the company during the month, so that is definitely part of the story. So at the end of the month, once you take all those things into account, the equity at the end of the month is $7,380. The third statement we're going to look at is the balance sheet. And unlike the previous two statements, the balance sheet is simply for a point in time. And that point in time is the end of day at the end of the month, the previous two statements we're looking at. So in this case, it is July 31st, 2019. Our balance sheet tells us about the company's assets, what the company has. So assets are something that the company owns. They have these assets to use in the future. Also tells about the liabilities. Liabilities is what the company owes, and equity is the owner's stake in the assets. So if you think about it, assets, you can either get assets by borrowing, or the owner has put in to get those assets for the company. And this is really what we're talking about when we're talking about that owner. Okay, now that we have all of our assets here, I want to point out a few things. First of all is the order of liquidity. So that's very important. The order of liquidity states that things should be listed in terms of whatever will turn to cash or be used up first. So cash is already cash, so that goes first. Accounts receivable is what your customers owe you, so they should be paying you very soon. So you should get that turned into cash very soon. Supplies will be used up way before your computer equipment, and your computer equipment or your furniture will last a little bit longer probably than your computer equipment. Just like before, we've got an underline denoting we're going to add all of these numbers up, but total assets gets a double underline, just like all of the double underlines that end the previous statements. Okay, now we are on to liabilities. Liabilities are what the company owes. And luckily, if we look over to our question, we don't have much left over. So I know accounts payable is definitely a liability. So that's it for that one. And basically, a big hint is anything that ends in the word payable is going to be a liability. So you could have interest payable, accounts payable, taxes payable, wages payable. All those things would be a liability, signifying that the company owes something. Finally, we have equity, and equity is the owner's stake in the company. We calculated Milton Windsor's capital at July 31st up here. That's the same number that goes down here. It is for July 31st, and that is when the balance sheet is for also. So once we do that magic trick, hot dog, if we take our total liabilities, add it to our total equity, we get the exact same amount as our assets right there. So if we think about assets, assets are the things that the company owns, and you can get things by either paying for them yourself or borrowing, and that's how it all works. Another common question, now that we're at this point with the balance sheet, is how much of the company's assets were financed by debt? So debt and liabilities mean the same thing, they're synonymous. So in order to figure that out, all we would need to do is take that total liabilities amount and divide it by our total assets, that number. and turn that into a percentage form, so times it by 100, and there you go, you'd find out that 17% of the assets were financed by debt. Concurrently, if you did the same thing, wondering how much was financed by equity, how much do the owner actually share in the assets? And look at those two percentages would add up to 100%. And this is for a time period, so for the month ended July 31st. This statement basically tells the story of cash, or what happened to the money in the company throughout the month. So how we went from this amount July 1st to this amount on July 31st. Now, lots of people say, why the heck do we need this statement when we have the income statement? So the income statement, it is tied to cash flow, no doubt, but here we're talking about our revenues and our expenses. So our revenues are what we're charging our customers for the work we completed during July, and our expenses, what we've used up while doing those services during July. It doesn't necessarily tell us when we get paid. We will definitely get paid for all of these revenues, and we will definitely have to spend all this money for the expenses. But it may not be in the month of July that the money will come out of our bank account. For instance, our revenues, we may do the work in July, but we may tell our customers, hey, pay in August or September. Same thing for utilities. We'll use some utilities in July, but we won't actually pay them. The money won't go out of the bank account until August. So because of this timing difference, that's why this statement, the statement of cash flow, is so important. Now, what you need to know for the statement of cash flows for this course is the three different sections. So the first section, cash flows from operating activities. This is the money that's going in or out of the bank account due to the normal day-to-day transactions from the company. Then we have cash flows from investing activities. Investing activities are when the company buys or sells big assets, like buying a bunch of equipment. That would take $2,200 out of the bank account and would be subtracted on our statement of cash flows. Cash flows from financing activity means owner investment, issuing shares, payment of dividends when owners withdraw out of the company. When you add up those three different sections of the financial statement, you'll get the net increase or decrease in cash. That'll be added to the beginning balance to get the ending balance for the year. Now, we won't actually be constructing these statements in the course, but it's really important to know the importance of this statement. Thanks. I hope you've enjoyed this video. Have a great day.